Something just changed in XRP that matters more than it looks. While most investors remain focused on short-term price action, the underlying infrastructure supporting digital assets continue expanding, and history shows those two trends often diverge before major market shifts. In this video, we'll examine the data behind Bitcoin's unique return profile, the institutional developments unfolding across the XRP ledger, stablecoin adoption, custody infrastructure, and the market signals that could help explain where the crypto ecosystem is heading next. Bitcoin has produced the highest compounded annual return of any major asset class over the past 15 years. Yet one statistic explains why so many investors failed to capture those gains. In many years, just 10 trading days generated the majority of Bitcoin's annual returns. Remove those days, and long-term performance changes dramatically, turning exceptional gains into significant average losses. That isn't simply a lesson about Bitcoin. It's evidence that markets driven by exceptional adoption often reward patience more than precision. Now, here's what makes today's environment particularly interesting. While investors debate whether prices are going higher or lower, next week, institutions are quietly building the infrastructure that could support the next phase of digital finance. Stable coins are expanding. Custody solutions are maturing. Blockchain foundations are strengthening their networks, and enterprise integrations continue moving forward, regardless of market sentiment. The question isn't just where prices go next. It's whether the underlying financial system is becoming more capable, more connected, and more valuable than the market currently recognizes. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down and simply so you can see what actually matters in the market. See, one of the most overlooked statistics in investing has nothing to do with interest rates, inflation, or even company earnings. It has everything to do with time. Over the past 15 years, Bitcoin has delivered the highest compounded annual return of any major asset class. Let that sink in. See, it has outperformed stocks, real estate, commodities, and even gold. Yet despite these extraordinary returns, many investors have dramatically underperformed Bitcoin itself. Why? Because they attempted to outsmart volatility. Research consistently shows that Bitcoin's annual gains are incredibly concentrated. In many years, just 10 trading days account for the overwhelming majority of total returns. Miss those few days, and the investment outcome changes dramatically. Some studies show that excluding those best performing sessions transforms extraordinary long-term performance into average annual losses approaching 27%. Let that sink in, ladies and gentlemen. Write that number down. Think about that for a moment. Missing only a handful of days each year doesn't merely reduce your returns. It can erase them almost entirely. And this is what most people miss. This isn't simply a Bitcoin story. It's a lesson about how exponential assets behave. Periods of fear often precede explosive recoveries. And because those recoveries arrive unexpectedly, investors who sell during uncertainty frequently miss the very moves they were waiting for. That's why experienced long-term investors often focus less on predicting tomorrow's price and more understanding whether the underlying system continues improving. Short-term noise, long-term structure. That distinction has separated many successful investors from everyone else. History has demonstrated this principle repeatedly. Consider the California gold rush. While thousands rushed west, hoping to strike gold overnight, many of the greatest fortunes were made by prospectors. They were built by businesses supplying the infrastructure, railroads, equipment, transportation, and essentially services that continued generating value, regardless of which individual miner discovered the next rich deposit. The lesson wasn't about predicting where every nugget of gold would appear. It was about recognizing that an entirely new economic ecosystem was being created. Today's digital asset industry presents a similar distinction. Daily price captures attention. Infrastructure captures value over decades. The market may celebrate speculation during bull runs, but institutions typically invest in the systems that allow entire financial networks to function. That difference is becoming increasingly important as crypto evolves beyond retail enthusiasm into enterprise adoption. Another debate attracting significant attention centers around indirect Bitcoin exposure. Should investors simply own Bitcoin, or should they purchase companies whose business models revolve around accumulating Bitcoin? Recent commentary from market participants, including Austin Campbell, has highlighted an important distinction. The real question isn't necessarily whether companies like Strategy will survive financially. Instead, investors should ask something much simpler. Does owning an intermediary actually outperform owning the underlying asset itself? For many participants, the answer remains uncertain. Corporate structure introduces additional layers of complexity. Management decisions, capital allocation strategies, debt issuance, equity dilution, operational risk. All of these factors become valuables and variables that don't exist when directly holding asset. As financial markets mature, we're also seeing an explosion of exchange-traded products, structured vehicles, custodial solutions, and leveraged investment products designed to provide crypto exposure. Those innovations undoubtedly expand access, but they also introduce counterparty risk and additional complexity. Price is reacting, systems evolving. For long-term investors, understanding that distinction may prove just as important as understanding the technology itself. History offers another powerful lesson. During the panic of 1907, confidence in the American banking system deteriorated rapidly. Liquidity evaporated. Financial institutions struggled to meet demand, exposing weakness within the existing system. The crisis ultimately accelerated reforms that transformed American finance and contributed to the creation of the Federal Reserve System only a few years later. The important takeaway isn't that crypto mirrors early 20th century banking. No. It's that major financial infrastructure often evolves after existing systems reveal their limitations. Periods of instability frequently become catalyst innovations rather than obstacles to it. But here's where the story becomes more significant. Instead of asking whether blockchain technology will replace traditional finance, many institutions are asking how blockchain can integrate with traditional finance. That shift in perspective changes everything. One organization working directly at the intersection is the XRP Ledger Foundation. While Ripple often attracts public attention, the foundation operates with a different mission. Its objective is to maintain a secure, community-driven institution, ready blockchain, capable of supporting real-world financial infrastructure. Rather than functioning as a commercial enterprise, the foundation focuses on governance, security reviews, validator participation, software quality, ecosystem collaboration, and long-term network resilience. That neutrality matters. Financial institutions generally prefer open standards rather than closed ecosystems controlled by a single commercial entity. As banks, payment providers, fintech firms, and enterprise developers evaluate blockchain integration, trust becomes just as important as transaction speed. The foundation therefore acts as one of the key stewards helping ensure that the XRP Ledger remains reliable, transparent, and suitable for institutional participation. Now, this is what most people miss. The largest financial transformation rally happened because of price appreciation alone. They don't. They happen because infrastructure quietly reaches the point where large organizations become comfortable deploying capital, building applications, and integrating critical services. That process is rarely exciting. It doesn't dominate headlines. But history suggests that long-term adoption often depends far more on dependable infrastructure than spectacular market rallies. If there is one trend that institutional investors are watching more closely than almost any other in digital assets today, it isn't meme coins or the largest, latest speculative tokens. It's stablecoins. For many years, many investors dismissed stablecoins as little more than digital dollars parked on blockchains. But that participation and perception has changed dramatically, ladies and gentlemen. See, increasingly stablecoins are being viewed as the payment rails that could underpin the next generation of global finance. Think of them as the highways rather than the vehicles, okay? People often focus on the cars driving across the road, but the road itself is what enables an entire economy to function. In much the same way, stablecoins provide the infrastructure that allows value to move quickly, efficiently, and around the clock. This is where recent developments surrounding RLUSD become particularly noteworthy. According to everyone's analysis surrounding RLUSD on the XRP Ledger has accelerated significantly in just 18 months. Stablecoin share of on-chain trading reportedly increased from less than 1% to approximately 12%. Meanwhile, RLUSD XRP trading pair processed roughly $900 million in trading volume over a 6-month period. It's massive, massive. Perhaps even more interesting, around half of all RLUSD currently in circulation is now issued on the XRP Ledger, a remarkable increase from roughly 17% only months earlier. See, these numbers matter because they suggest something larger than speculation, ladies and gentlemen. Every transfer, every settlement, every liquidity event increases network activity. That activity strengthens the ecosystem regardless of whether investors are discussing daily price movements. This illustrates an important principle. Prices reacting, systems evolving. Those two trends do not always move together. A useful way to understand this transformation is through history. Imagine the construction of the Roman road network. The roads themselves were not the financial objective. They were the infrastructure that allowed commerce, communication, military logistics, and economic expansion to flourish across an empire. Blockchain infrastructure functions in a surprisingly similar way. The ledger itself is the road. Stablecoins are the commercial traffic. Financial institutions become the businesses deciding whether to build alongside those routes. The more activity a network attracts, the more valuable its infrastructure potentially becomes. This does not guarantee future price appreciation, but it does demonstrate why institutional observers increasingly focus on network utility rather than short-term market excitement. Short-term noise, long-term structure. The distinction is becoming increasingly important as blockchain technology matures. Another major institutional development has attracted considerably less public attention than it probably deserves. Wyndham, a trade orchestration platform recently integrated with the Ripple custody. At first glance, this may sound highly technical. In reality, it represents another piece of institutional plumbing. Large financial organizations rarely execute trades using a single system. Instead, they coordinate multiple exchanges, custodians, liquidity providers, treasury operations, compliance systems, and report frameworks simultaneously. Trade orchestration software helps connect those moving parts. Ripple's custody platform provides secure storage and management of digital assets. Together, these services contribute towards a more unified operational framework capable of supporting banks, asset managers, payment companies, and institutional trading desks. This isn't the type of announcement that typically sends prices soaring overnight. Infrastructure rarely works that way, but digital assets are eventually adopted. At institutional scale, much of the adoption will depend upon indivisible systems functioning reliably behind the scenes. Most people never think about payment networks when they tap a debit card. Likewise, future blockchain users may never think about custody platforms, orchestration layers, or settlement engines. Ironically, that could be the strongest evidence that the technology has succeeded. Meanwhile, technical analysts continue monitoring XRP for signs that the broader market cycle may be approaching an important turning point. One widely discussed observation involves the Relative Strength Index, or RSI. Historically, XRP established important long-term lows after reaching deeply oversold monthly RSI readings before recovering. This cycle has behaved differently. According to analysts, following the monthly chart, XRP's RSI declined below previously historical thresholds, briefly moving beneath levels around 41, 42, and even 40. That represents one of the most oversold conditions recorded on the asset's monthly time frame. Why does this matter? Technical indicators do not predict the future. However, they can sometimes provide insight into changing market momentum. Analysts are particularly watching for the possibility of bullish divergence. That occurs when price records a lower low while momentum indicators begin making higher lows. Such divergence have historically appeared near important turning points across many financial markets. Of course, no indicator guarantees a reversal. Markets can remain oversold for extended periods. Economic conditions change. Investor sentiment shifts. Unexpected macroeconomic developments can alter any technical setup. And that is why experienced investors generally combine technical analysis with broader structural research rather than relying on charts alone. Another discussion generating attention involves market timing. Some analysts believe Bitcoin, and by extension, much of the digital asset market, could establish an important cyclical low during the coming months, based on previous market behavior. Whether those projections ultimately prove accurate remains to be seen. History rarely repeats perfectly. It often rhymes. Markets evolve. Participants change. Regulation develops. institutional involvement grows. Every cycle introduces new variables. Attempting to identify the exact bottom has always been extraordinarily difficult. Ironically, that brings us back to where the discussion begins. Bitcoin's remarkable long-term returns have historically depended upon remaining invested during a surprisingly small number of exceptional trading sessions. Missing those sessions has proven extraordinarily costly. That reality reinforces one of the central lessons discussed throughout this video. The greatest challenge is often not identifying opportunities. It is maintaining conviction while understanding dominates the headlines, ladies and gentlemen. Today's crypto market looks very different from the one that existed only a few years ago. Banks are exploring blockchain settlement. Stablecoins are becoming critical financial infrastructure. Independent foundations continue strengthening open source networks. Custody solutions are becoming increasingly institutional. Liquidity infrastructure continues to expand. Trade orchestration platforms are connecting fragmented networks and markets. Meanwhile, investors remain focused on short-term price fluctuations. That contrast may ultimately define this period in digital asset history. Because while headlines continue discussing volatility, the underlying system continues developing. Whether discussing Bitcoin's unique return profile, the growth of stablecoins on XRP Ledger institutional custody integrations, or the expanding role of blockchain infrastructure, one common theme appears again and again. Adoption is not a single event. It is a process. Sometimes that process moves quietly. Sometimes it accelerates rapidly. Often it advances long before market participants fully appreciate what is changing beneath the surface. And that is why experienced investors frequently separate temporary market sentiment from long-term structural evolution. Short-term noise, long-term structure, prices reacting, systems evolving. Those two ideas may become increasingly important as digital assets continue their transition from speculative investments toward components of the broader global financial system. If you found this breakdown valuable, remember that the biggest stories in crypto are rarely the loudest ones. They are often the structural developments unfolding behind the scenes, developments that may shape markets for years rather than days. Thank you for watching. If you enjoyed this analysis, be sure to like the video, subscribe for more macroeconomic and institutional crypto insights, and let me know your thoughts in the comments below. As always, continue doing your own research, stay informed, and remember that while no one can predict markets with certainty, understanding the direction of underlying systems may ultimately prove more valuable than trying to predict tomorrow's price actions. I'll see you in the next video. Hope everyone's having a blessed afternoon, ladies and gentlemen. I want to welcome all the new members of the Patreon, all the new members of the membership channel. It's amazing what we're seeing in today's environment. It really, really is. But there's so many competing themes. It's really hard to even understand what is right and what is wrong. Should one be long? Should one be short? None of this is financial advice. It's just my own opinion or intentions in any capacity. Something that I'm paying attention to right now. And again, see, part of being a financial mercenary is knowing when to not get cut up like sushi. You're probably asking, how does one know when not to get cut up like sushi? One of the biggest things I was told on the floor of the New York Mercantile Exchange is how much time I have been in the market as opposed to how much I have in the market. That was one of the biggest principles that was drilled into my mind. Because the market itself is doing a lot of different things. I'm paying attention to Japan. I always tell you the Widowmaker. I always tell you Japan. But Japan is playing currency chicken, and almost nobody sees the bigger trade as far as we're concerned. See, something is changing, ladies and gentlemen. And no, I'm not talking about the 1% move in the Japanese yen. I'm talking about the fact that the governments are starting to change how they communicate within markets. And that may be far more important than the intervention itself. Everyone focuses on one question. Will Japan intervene? See, I remember when I first started my career as well, watching the BOJ intervene was easy money. It was raining money. But today, that's the wrong question, okay? The better question is, what happens when traders no longer know when the intervention is coming? Write that down. That's a completely different game, ladies and gentlemen. For months, speculative funds have treated the yen like free money. Borrow yen, sell yen, buy higher yielding assets. I told you, collect a carry. I bought my first house in the early 90s from the carry trade. Game's changing, ladies and gentlemen. Repeat that. It's been one of the most crowded trades on the planet Earth. The result? The yen collapsed towards 161 per dollar, levels not seen since the mid-1980s. Write that down. We're talking about a major G7 currency sitting near 40-year lows. Okay? It's massive. Normally that doesn't happen without serious structural problems. See, Japan certainly has challenges. Interest rates remain dramatically below U.S. rates. The Bank of Japan has been incredibly cautious compared within the Federal Reserve. That creates enormous interest rate differential, ladies and gentlemen. It's massive. It's so big. But money naturally flows towards higher yields. That's economics. But once positioning becomes one-sided, markets become vulnerable. This week may have shown exactly that. See, reports suggest Japanese officials may stop telegraphing intervention ahead of time. Think about this for a second. This is so crazy, but it's massive. It is. See, historically, policymakers often sent signals before stepping into the market. Warnings, verbal interventions, hints, enough to make traders cautious. What happens if those traders and warnings disappear? What happens? Suddenly, every trader holding a massive short yen position has to ask themselves one uncomfortable question. What if intervention happens while liquidity is terrible and I get cut up like sushi? That's exactly what makes holding periods so dangerous and holiday periods so dangerous. Thin liquidity doesn't require billions upon billions of dollars to move prices. It's the exact opposite. There simply aren't as many buyers and sellers. Smaller orders create larger moves. If authorities choose their timing carefully, they can maximize market impact. That's why the U.S. holiday period immediately became part of the discussion. Not because holidays are magical. To me, they're magical. But because liquidity matters. See, Finance Minister Satsushi Kadamata reinforced that uncertainty by saying authorities stand ready to intervene whenever necessary while emphasizing ongoing communication with the United States regarding foreign exchange policy. Notice what isn't being said. No specific level, no explicit trigger, just uncertainty. Markets hate uncertainty, especially leveraged traders, and we immediately saw positioning unwind. The yen surged roughly 1%. So huge. Now, 1% doesn't sound dramatic. In currencies, it's enormous, ladies and gentlemen. It's massive. That's massive, especially for one session, especially after months of relentless weakening. But here's where things become, at least as far as I'm concerned, what has to be paid attention to, as far as I'm concerned, and anyone retains any capacity. None of this is financial advice, just my own opinion. It retains organizational capacity. So the yen wasn't just helped by intervention fears. The U.S. dollar weakened as softer than expected unemployment data caused markets to reassess expectations for Federal Reserve policy. See, remember, currencies are always relative. You have to remember this. If U.S. interest rate expectations decline while Japanese policy remains unchanged, the interest rate gap narrows, at least in expectations. Sometimes expectations move markets more than actual policy. That's an important distinction, ladies and gentlemen. Markets don't wait for tomorrow. They price tomorrow, today. See, this isn't just about Japan. There are multiple macro stories colliding simultaneously. Ladies and gentlemen, if you want to learn how to trade, if you want to learn how to invest, if you want to learn how to take advantage of everything that I discuss right here, come and join the Crypto Public Desk Monthly and join over 600 active traders and investors who are learning how to take advantage of all this deeper macro research that we go over here right now. See, in the videos are free. I set the table for what we're watching and why, but inside we do the deep dives, price points, levels, stop losses, the logic behind everything. Join one of the fastest growing active communities, the Crypto Public Desk Monthly. We're going to be capping the number at 1,000. Ladies and gentlemen, I want to talk about copper. I love copper, constant copper. See, copper prices have reached record highs this year. Many people immediately assume miners are printing money, but that's only part of the picture. The refining industry tells an entirely different story. Treatment charges for 2026 benchmark contracts have reportedly fell to zero. Spot treatment charges have even turned negative. That sounds bizarre. How can processing become unprofitable and copper prices are making new highs? Simple. Too many smelters. Not enough concentrate. The bottleneck isn't demand. It's upstream supply. Years of investment decisions create excessive refining capacity while mine production hasn't kept pace. That's a classic supply chain imbalance. High prices don't automatically benefit every participant. And there's two names in the copper industry that are going to really, really win. We're going to be letting those go inside the crypto monthly, inside the Patreon. The link is pinned in the description and the comment section. But sometimes they expose weakness in business models. Only the most efficient operators survive. That's an important lesson investors often overlook. See, in Asia, crude imports recovered somewhat in June, but the headlines are missing something really important as far as we're concerned. Imports remain roughly 5 million barrels per day below pre-conflict levels. Write that down, ladies and gentlemen. That's so enormous. See, the Strait may be functioning again, but shipping patterns haven't normalized. Those are night and day. Supply chains rarely snap back overnight. Refiners have been forced to source alternative grades. Logistics remain disputed. Insurance costs change. Shipping routes change. Risk premiums change. Markets often celebrate reopening headlines long before physical trades actually recover. Eventually, production should increase. The International Energy Agency expects global supply could exceed demand next year. That's correct. Today's geopolitical premium may slowly fade. That's something worth watching carefully because energy influences almost every major economic, thorough transportation, manufacturing, inflation. Now let's shift to technology. One of the most fascinating divergences in the markets is happening inside semiconductors. The SOX Semiconductor Index just delivered one of its strongest quarters ever. Meanwhile, many of the mega cap technology leaders struggled during June. Why? Because investors are beginning to separate AI infrastructure, spending AI from profitability to theory. See, chip manufacturers continue benefiting from extraordinary demand, but markets are beginning to ask tougher questions. How much capital spending is enough? When does investment become overspending? Can cloud providers continue spending hundreds of billions of dollars every year? Will returns justify those investments? Those aren't bearish questions, ladies and gentlemen. They're valuation questions. And earnings season could be critical. Investors don't simply want promises anymore. They want measurable returns, revenue, margins, free cash flow, utilization, order books, guidance, real numbers. Because AI excitement alone cannot support valuations forever. Eventually, every investment must produce economic returns. We tie all these stories together. Japan, copper, oil, semiconductors, they seem unrelated. They're actually connected by one common theme. Markets are transitioning from narratives back towards fundamentals. Currency traders suddenly care about positioning. Commodity traders care about physical bottlenecks. Energy traders care about logistics instead of headlines. Technology investors care about earnings instead of excitement. That's healthy. Fundamentals eventually matter. They always do. And here's something experienced macro investors understand. The biggest opportunities often appear when several independent markets begin sending these same messages. Right now, we're seeing stress in positioning, stress in supply chains, stress in valuations, stress in policy expectations. Individually, they're interesting. Collectively, they're significant. Because macro investing isn't about predicting one headline. It's about recognizing patterns before they're obvious. That's exactly why data matters, not opinions, ladies and gentlemen, not emotions, not social media narratives. Actual positioning, actual flows, actual productions, actual earnings, actual probabilities. Those are the signals that separate noise from opportunity, ladies and gentlemen. The next few weeks could become unusually important. We're going to hear from central banks. We'll receive corporate earnings. We'll watch labor markets. We'll monitor oil flows. We'll see whether the yen stabilizes or whether policymakers decide actions speak louder than words. Volatility may not be disappearing. It may just be changing shape. And that's usually when most informed investors pay the closest attention. Ladies and gentlemen, if you want to learn how to trade, if you want to learn how to invest, if you want to learn how to take advantage of everything that's going to be changing in the markets, if you want to hear the next two massive copper plays, come and join the Crypto Public Desk Monthly inside of the Patreon. The link's below, pinned up, and in the description. Come and join over 600 active traders investors who are taking their destiny into their own hands and learning the trade craft of the open outcry floor trader that I learned in the NYMEX. As always, ladies and gentlemen, this is not financial advice. This is just my own opinion. This content is for educational, information, and entertainment purposes only. Always do your own research and consult a licensed financial advisor. As always, I love you all. I'll see you on the front lines, ladies and gentlemen. Have a blessed evening. Love you all.